are going to complete our discussion about audit planning. The last time we have explained the first two stages of audit planning, assessing acceptable audit risk and inherent risk, accept client and perform initial audit planning. Today we will complete the other steps: understanding the client's business and industry, assessing client's business risk, and finally performing introductory analytical procedures. In recent years, several factors have increased the importance of understanding the client's business and industry. Recent significant declines in economic conditions which increase clients' business risk. Nowadays, there is a severe global economic recession because of the coronavirus great shutdown. Prior to this, in 2008, there was an economic crisis because of the bursting of the US housing bubble. In 2008, there was another financial crisis because of the technology bubble. So the decline in the economic conditions, the economic recessions and financial crisis significantly increase clients' business risk. Clients have expanded operations globally. Number of multinational corporations has increased significantly, operating in many countries other than home countries. Using information technology that increased the client's connection with customers and suppliers also increased the importance of understanding the client's business and industry. The increased importance of human capital and other intangible assets has increased accounting complexity and increased the importance of management judgment and estimates. Intangible assets such as patents, goodwills, trademarks, and human capital are usually very hard to evaluate and requires a high degree of estimation and subjectivity. So the increased importance of intangible assets has increased the importance of understanding the client's business and industry. The increased investments in complex financial instruments. Examples of complex financial instruments include derivatives, warrants, asset-backed securities. In order to understand the risk of these financial instruments, you must have both knowledge and experience of the characteristic of the instruments, such as its complexity, technical structure, and financial risk. All these factors have increased the importance of understanding the client's business and industry. So the auditor needs to understand the client's industry and the external environment, the client's business operations and processes, the client's internal corporate governance, the client's organization objectives and strategies, and the client's organization performance measurement. So the auditor needs to understand the client's industry and external environment. There is high risk associated with the specific industries, and this may affect the auditor assessment of the client business risk and acceptable risk, such as in case of financial institutions and insurance companies. Such sectors need understanding from the auditor. Many industries have unique accounting requirements, such as in case of construction and not-for-profit organizations. So the auditor must have enough knowledge with respect to such industries. You need to recognize that many auditors' litigation cases result from the auditor's failure to understand the nature of transactions in the client's industry. So it is very important that the certified public accounting firm has appropriate understanding of the client industry and external environment. The auditor must understand the client's external environment, including things such as economic condition, competition, and governmental or regulatory requirements. The auditor needs also to understand the client business operations and processes. In specific, the auditor should understand the client's key sources of revenues, key customers, sources of finance, and suppliers. In order to obtain such understanding, the auditor can tour the client's facilities, observe operations, and meet key personnel. The auditor should also identify related party transactions because there is high risk that these transactions may not be valued at the same amount as transactions with independent third party. Examples of related party transactions include sale or purchase transactions between parent and subsidiary, exchange of equipment between two companies owned by the same person. There is high risk associated with related party transactions. They may be not valued at the same amount as transactions with independent third party. That's why the auditor needs to have understanding and identify such related party transactions early in the audit engagement. The auditor should also understand the client's corporate governance mechanism. In specific, the auditor should understand the organizational structure, including head of departments, authority and responsibility cycles, role of board of directors in exercising oversight and in taking only appropriate decisions and risks, role of audit committee in exercising oversight over financial reporting process, and the role of audit committee in ensuring high quality financial reporting. In order to obtain such understanding, the auditor can check whether the client adopt code of ethics that applies to senior management, including chief executive officers and chief financial officers. The auditor can also review corporate minutes that represent official record of the meetings of the board of directors and the stockholders. These records include key authorizations and summaries of the most important topics discussed at these meetings and the decisions made by the directors and the stockholders. So it is very important that as a certified public accountant to understand the client's corporate governance mechanism. The auditor should also understand the client's objectives and strategies. In specific, the auditor should understand the client's objectives and assess the degree to which there is business risk that threaten management's ability to achieve such objectives. This helps to assess inherent risk in the client's financial statements. Basically, if the client has set of unreasonable objectives, inherent risk of financial statement misstatement may be increased. If the client has unrealistic objectives, would like to beat the market or beat analysts' forecasts, for instance, this will represent a motivation for management to manipulate earnings, to exploit the accounting choice to overstate earnings in the short term, to exploit subjective assumptions and estimates inherent in the measurement of accruals, for instance, to manage earnings upwards by overstating or understating provisions for bad debts reserves, fixed assets and goodwill impairments, and so on. In order to obtain such understanding, the auditor can review the terms of clients' contracts and other legal obligations. The auditor can also review the client's budgets to assess the client's sales plans and earnings forecasts to have an understanding of the client's objectives and targets. The auditor should also understand the client's performance and measurement system. The auditor should understand the key performance indicators included in the client's performance measurement system that management uses to measure progress towards its objectives, such as market share, earning per share, unit sales growth, sales per employee, financial ratios including return on assets and return on equity, and so on. As part of understanding the client's business, the auditor should perform ratio analysis or review the client's calculations of key performance ratios. In this context, the client compare the client's indicators with previous years in order to check whether there is abnormal amounts or odd amounts, in order to assess fluctuations over time, and compare the client's indicators with industry average in order to assess risk of financial statement misstatement. The third step in the audit planning process is to assess client business risk. Business risk is the possibility that the client will fail to achieve its objectives. Client business risk arises from any factor affecting the client and its environment, such as significant declines in the economy, new technology that decreases the client's competitive advantage, change in demand for products, change in the government fiscal policy, mismanagement of the client organization. The auditor has responsibility to assess client business risk, and auditor assessment of the client business risk considers the client business and external factors, client business strategies and processes, management controls that can mitigate business risk, and in this context it's important to point out that the Sarbanes-Oxley Act of 2002 requires management to design controls and procedures to ensure that material information about the business risk is communicated to management and disclosed to external stockholders. The last step in the audit planning process is to perform introductory analytical procedures. Analytical procedures is the evaluation of financial information through analysis of plausible relationships among financial data. Analytical procedures is one of the audit procedures that may be performed in the planning phase and in the testing phase of the audit, and we have explained the analytical procedures among the audit procedures in the previous chapter. When performing analytical procedures, the auditor investigates unusual fluctuations in financial data that differs from expectations developed by the auditor. So analytical procedures use comparisons and relations to assess whether account balances and other data appearing in the financial statements is reasonable relative to auditors' expectations. Usefulness of analytical procedures as audit evidence depends on the auditor's developing of an expectation of what a recorded account balance or ratio should be. Auditor develops such expectation of an account balance or ratio by considering information from previous years, previous accounting periods, industry trends and averages, client prepared budget expectations, and so on. These are examples of analytical procedures. The auditor may, for example, compare the days sales outstanding metric to the amount of previous years. This relationship between receivables and sales should remain about the same over time unless there have been changes in the customer base, the credit policy of the organization or its collection practices, and this is a form of ratio analysis. The auditor may also review the current ratio over several reporting periods. This comparison of current assets to current liabilities should be about the same over time unless the entity has changed its policies related to accounts receivable, inventory, or accounts payable, and this is a form of ratio analysis as well. The auditor can compare the ending balances in the compensation expense account for several years. This amount should rise somewhat with inflation. Unusual spikes may indicate fraudulent payments are being made to fake employees through payroll system, and this is a form of trend analysis. The auditor can also examine trend line of bad debt expense This amount should vary in relation to sales. If not, management may not be correctly recognizing bad debts in a timely manner, and this is a form of trend analysis that can be used to detect earning manipulation practices. When the result of these analytical procedures are significantly different from expectations, the auditor should discuss them with management. And the auditor should keep in mind in this context that management may be hiding fraudulent behavior. The management may be hiding earning manipulation behavior. Management responses should be documented and could be valuable as a baseline to conduct further audit procedures.